Mpetsi traders, this is a very nice question, and the reason why I'm saying that is just purely the layout of the question. It is in a essay type of format. It's an email that the guy sends to another guy, you, and he's giving you a lot of information, but nowhere there's a table with all kinds of amounts included in the table, which you're just going to add and subtract. Everything is, like I say, in essay format, and at the end of the day, they require from you the statement of financial position of Mpetsi traders. You can ignore comparative figures and the equity section of the statement. Then also the accounting policy note and other notes to the financial statement is not required. But guys, although these notes are not required, because I only have to show a one-line item, for instance, for trade and other receivables and trade and other payables, by implication, even if they don't even ask the note, you have to do the note in order to derive at the total figure for that line item which you're going to disclose in the statement of financial position. Also, in a question like this, I would again strongly recommend that you start off with your template. You need a complete template for the statement of financial position, and it always looks more or less the same. There could be an additional line item here and there, but actually overall it is exactly the same for everything. So once you've written down your template, you can start to answer the question and deal with it point per point. Good. Mpetsi Traders is a company trading in the buying and selling of cleaning products and is situated in Pretoria. Mpetsi has been expanding the business and has become known for quality products that the entity sells. The entity was established in 2002 and has been registered for VAT since the inception date. The financial year end is 30 June. Also, you have to do the statement of financial position as at 30 June 2018. So that's the year that we are actually interested in. Good. You may assume a VAT rate of 14%, very important, on all transactions regardless of the transaction date. All merchandise are acquired from other registered vendors. Stock records are maintained by using the perpetual inventory system, and the value of stock items are determined on the first in, first out method. Mpetsi also has a policy to create allowance for settlement discount accounts where appropriate. The financial manager, Mr. David Ismail, became very ill during the last week of June 2018 and have asked you, a first-year trainee, to assist him in preparing the statement of financial position of the entity and to also gain some experience in the preparation of financial statements. Mr. Ismail sent the following email to you. Best first-year trainee. Please study the following information and if need be, please do not hesitate to contact me should you need any assistance. Although the doctor booked me off from work, I'm available on my email. Amounts receivable. Good. Trade and other receivables, in other words. On 30 June 2018, the debtors control account had a balance of 513,000. During the years of trading, Mpetsi established a good relationship with the majority of its clients that conducts business on a regular basis with Mpetsi. As from the beginning of the 2018 financial year, Mpetsi introduced an 8% settlement discount should clients settle their accounts within 25 days from the invoice date. 80% of the total outstanding debtors represent regular clients, and on 30 June, they all still qualified for the 8% settlement discount. Now let's write it down for ourselves so that we don't forget about that. We said we had at year end a total amount of debtors of 513,000. Then we said, well, included in that amount is 80% of them. And 80% of them equals, let's just put it in red, 80% of them equals an amount of, I'm going to do it now, 80% of them equals an amount of 410,400. So 80% of that amount of 51313 gives us an amount of 410,400. And then the other 20% of that amount equals an amount of 102,600. That is the 20%. Now, whenever you're going to answer a question, guys, make it as visible as possible for yourself. Because just to read everything and do not sort everything in a workable way for yourself, you are really going to battle. Now, they tell us that this 80% of debtors, they still are in line for an 8% settlement discount. So therefore, if I want to calculate my settlement discount, I can do so because the next paragraph is all about the 20% debtors. So that settlement discount is going to be equal to the amount of 410,400. That equals what? The invoice price. On what do we calculate settlement discount allowance account? On the VAT exclusive amount. So think back, what is the process? Determine the invoice amount. I have the invoice amount. What do I do now? If I have the invoice amount, take out the VAT. Let's take out the VAT. And then what I do then? Then I multiply that by the settlement discount, and in this case, an 8% settlement discount. And that is going to be my allowance for settlement discount at the end of the period, which equals 28,800. Good. Now we can continue with the other 20%. What should we do with the other 20%? Good. Included in the remaining 20% balance is an amount of 79,800 owed by a client called Hofstein. This account has been outstanding since March 2017. On 30 June 2017, Mpetsi did not create an allowance for credit losses on this account. Management has now, however, decided to write off this account as irrecoverable. This entry must still be recorded. Now remember, how much are we going to write off? We're going to write off our creditors amount, our debtors amount, a total amount of 79,800. Then we must remember, what are we going to do? We're going to debit credit losses with a VAT exclusive amount. So our expense account is going to be debited with 22,800 divided by 79,800 divided by 1.14 times 0.14, and that is going to be 70,000 credit losses and 9,800 VAT. We don't need the credit losses in this specific answer, but what we do need is the VAT of 9,800. And what is it going to be, an input or an output? It's going to be input VAT, so it's going to be a debit against our VAT control account. Good. Now they continue to say the remainder of the 20% balance. So if I'm going to deduct that 102,700 less the 79,800, that then gives me a total of 22,800. So they say that 22,800, which is 102,600, less the 79,800, is owed by Cable Industries. Cable had not been a client of Mpetsi for longer than a year. It came to the attention of Mpetsi that Cable is experiencing serious financial difficulty, especially taking into account that the entity had to retrench 3/4 of their workforce and that the share price of Cable has decreased from 44 Rand per share to 5.50 Rand per share. It sounds like Sasol. From newspapers, the story told is that a very well-known auditing firm has issued a qualified audit report on the last financial statements of Cable. I've already discussed the matter with management, and it was agreed that the accounting records must be adjusted by creating an allowance for credit losses on the outstanding balance on this account. So what is going to be our allowance for credit losses that we are going to create now? The total outstanding balance is 22,800, but we have to take out the VAT in order to create the allowance for credit losses, which is then 20,000. So what is our entry going to be? We're going to debit an expense account, credit losses or credit losses adjustment account, 20,000, and we're going to credit an allowance for credit losses for 20,000 Rand, which obviously needs to be disclosed. So we have that allowance there. What is our total debtors balance after we have written off this bad debt of 79,800? Because that is going to go against the total account. So our total remaining balance that we're going to show is going to be 433,200. Right, let's see if they want us to do something. That is in trade receivables. On 30 June 2018, Mpetsi was expecting a VAT refund. That means the receiver of revenue owes them money for VAT, amounting to 68,000 Rand. So my VAT control account had a debit balance of 68,000. On the same date, auditors from SARS paid Mpetsi a routine audit. The auditors found that Mpetsi claimed VAT on a double cab Isuzu delivery vehicle. Documentation of the vehicle is 100% in order. However, the vehicle is not seen as a delivery vehicle for VAT purposes, and VAT was wrongfully claimed. Guys, you're not allowed to claim VAT out of a business perspective on a double cab bakkie, because he classifies a double cab as a passenger vehicle, and he does not allow you to claim VAT on passenger vehicles. The business can, however, claim VAT on all other vehicles that he uses for business purposes. So if you have a single cab bakkie, you can claim VAT. Even if you have an extended cab bakkie, you can claim VAT. But if you have a double cab bakkie, that is a passenger vehicle and you cannot claim VAT. We have no choice than to amend the accounting records. The cost price, excluding VAT, paid in cash for the said vehicle amounted to 375,000 Rand, and the transaction occurred on 1 April 2018. Now that particulars we're going to need a bit further on in the question. So what are we going to do here? That means, what did we do? We claimed the VAT previously. So the amount that we claimed was 375,000 times 14%, which equals a total amount of 52,500. So what are we going to do? If we're going to reverse that, we're going to pass a credit against our VAT control account, and we're going to pass a debit against our vehicles account. Also for that same amount. Good. So let's quickly, before we move on to property, plant and equipment, and have a look how our trade and other receivables will look like at this point of time. Trade and other receivables. Our trade debtors is going to be 433,200. 433,200. Then we're going to have less allowance for settlement discount amount, 28,800. There it was, 28,800. Then we're going to have our allowance for credit losses, 20,000. And there we've worked out our allowance for credit losses here. It was the outstanding amount belonging to Cable divided by 1.14 equals 20,000 Rand, which is that 20,000 Rand there. Our net trade debtors then at the end of the day is going to be 433,200 less 28,800 less 20,000 equals an amount of 384,400. Our VAT control account, we are not 100% done with that one, but we can start building towards the final balance. It has an opening balance, a debit balance of 68,000. So write for yourself what kind of balance, so that if this thing turns around into a credit balance, you're going to show that not part of trade and other receivables, but trade and other payables. The VAT that we were not supposed to claim was the VAT on that vehicle. The VAT on that vehicle being the total amount of 52,500. Then on the credit losses that we've written off, we can claim now 9,800 Rand worth of VAT. So it was that entry that we had passed there. So that we can also update our VAT control account. Right, now let's continue then with the question. The next portion is all about property, plant and equipment. They tell us land and buildings. Land and buildings are not depreciated and was purchased on 2 January 2018, so in the current financial period, and was properly recorded at 1.5 million Rand. So immediately we know that this, remember for property, plant and equipment, we only show a one-line item in our statement of financial position. So I'm not allowed to show land and buildings, vehicles, equipment, whatever. I only have one line item, property, plant and equipment. Good, let's have a look at vehicles. Vehicles had a carrying value of 875,000 Rand at year end. But that 875,000 Rand was before we have passed that entry, where we debited the vehicles again with 52,500. So if we're going to look at the end of the year, 875,000 was what was lying as my carry value, but then I've passed an adjustment entry of 52,500. The correct depreciation was processed for the year. Vehicles are initially recorded at cost and subsequently measured at cost less accumulated depreciation. Depreciation on vehicles are provided for by year end and by application of the straight line method at 25% per annum. Vehicles are deemed to have no residual values. Now, if it was recorded correctly in our books and if the depreciation was recorded correctly, why bother with the rest? Guys, because for that 52,500, no depreciation was actually calculated for the year. Why not? Because it was not formed part of the cost price of that new vehicle, which was now included in the 875,000. So what we have to do is to work out what was our depreciation on that specific vehicle adjustment account. So if we say we have this rectification of 52,500, there's no residual value, so the depreciable amount is also 52,500. We are writing off depreciation at 25% per annum, and we have purchased that vehicle on 1 April 2018. So we've used that vehicle for a period of 3 months in the current financial year. In total then, we have understated our depreciation charge for the year with 3,281. If we have understated our depreciation charge, what will that mean? It means we're going to debit depreciation now with 3,281 and credit accumulated depreciation with 3,281. And that will then mean that we have to write off that 3,281 in order to derive at the correct carrying value of my vehicles at the end of the year. And that gives us then a total of 924,219. So that is our actual carrying value of our vehicles at the end of the period. Good. Now equipment. Equipment had a carrying value on 1 July 2017, the beginning of the current financial year, amounting to 80,000 Rand. Equipment is initially recorded at cost and subsequently measured at cost less accumulated depreciation. All equipment was purchased on 1 July 2014 and had an estimated residual value of 10,000 Rand. Equipment is depreciated annually by the application of the reducing balance method of 15% per annum. Therefore, I'm going to ignore my estimated residual value. Why? Because that estimated residual value has already been discounted into the 15% per annum that I am going to use. Now, it doesn't look, they just give us the carry value as at that date. So therefore, on the beginning of the year. So therefore, we still have to go and calculate our carry value at the end of the year. So 80,000 carrying value at the beginning of the year. What is going to be our depreciation? It's going to be 15% on that amount, and that gives us 12,000 Rand. So 80,000 less 12,000 Rand is going to be our carrying value of this asset at the end of the year of 68,000 Rand. So at the end of the year, for equipment, it's going to be 68,000 Rand. For vehicles, it's going to be 924,219. And for land and buildings, it's going to be 1.5 million. So if we're going to add all those together, we will get total property, plant and equipment for the current financial period. 1.5 vehicle for the land and buildings, the 875 plus the 52,500 less the 3281, all three of them together gives us a total there of 924,219 for vehicles, and then equipment, after we've deducted the current year's depreciation, gives us a carry value of 68,000, and if we add everything together, 2,492,219. In our statement of financial position, Mpetsi Traders statement of financial position as of 30 June 2018 Rand. Non-current assets, property, plant and equipment, a one-line item with a total of 2,492,219. Good. If we also go here under trade and other receivables, we have actually finalized our total trade and other receivables. So under current assets, trade and other receivables, the total of 416,549, but we still haven't finalized those two figures. So that is only the final figure. Let's continue now with the question. The loan. Now they tell me the loan. Land and buildings were financed by a loan that was acquired by Mpetsi Bank. The loan amount was paid into Mpetsi Bank account on the same date that land and buildings was acquired. Now, here they've told us that date was 2 January 2018. Very important. So 2 January 2018. And that is our current financial year halfway through. Good. They tell us then the particulars of the loan. The loan carries a fixed interest rate of 8% per annum and is settled by payment of biannual installments. That means twice a year, of 223,544 each. So twice a year we're going to pay them an amount of 223,544, which includes capital and interest, as from 30 June 2018. So the first payment was supposed to take place right at the end of the current financial year. The debit order for the payment due 30 June 2018 only appeared on the bank statement on 2 July 2018, due to the fact that 30 June was on a Saturday and debit orders only went through on a normal business day. No accounting entries were passed to record the payment as yet because fair cash flow hasn't taken place before year end. What do you think? Do you think it's right? Do you think it's wrong? Guys, when did the actual payment took place? And that is very important that you realize that. The actual payment took place on 2 July. So that means, what was my commitment at 30 June? Have I paid them already? No, I haven't. So my total commitment on 30 June was still an amount of 1.5 million Rand. Now, what are we going to show in our statement of financial position? The first thing that we have to work out is that we haven't provided for interest at 8% per annum because we have paid the interest with a capital amount only on 2 July. We need, though, the amortization table in order to work out the split between interest and capital. The amount that we've borrowed was the amount of 1.5 million rand, the cost price of land and buildings. Now the interest, remember it was on 1 or 2 January, right in the beginning of the year. It's actually 2 January and not 1 January. Good. So we're not going to penalize them for 1 day's interest, we work with months. 1.5 million multiplied by the interest rate of 8% for a period of 1 Jan to 30 June, which equals 6 months. So 1.5 million times 8% for 6 month period give us interest for the current year of 60,000. How are we going to record that interest, guys? We're going to say, let's do it here, interest expense. We're going to debit 60,000 and accrued interest or interest payable, which is a current liability, we're going to credit with 60,000. Then we have recorded that transaction. Good. The second thing that we're going to do is, well, we have given them a payment of 223,544. That's what they tell us. They say biannual installments of 223,544 each. So that is the amount which was paid on 2nd of July. If 60,000 Rand of that amount is interest, it means that the difference between that amount is going to be capital. So what is the outstanding capital balance then after this payment has been made on the 2nd of July? It will be 1.5 million less 163,544. Now, we have to split in our statement of financial position between the long-term portion and the short-term portion of the long-term loan. Now, how many payments effectively is going to happen next year? It is the one on the 2nd of July, it's the one at the end of December, and it's the one on the 30th of June of the next financial year. So next year, this payment will go through on the 2nd of July. These two payments will go through at the end of December and the end of June of next year. So therefore, I have to work out in my amortization table the next two payments amortization in order to derive at the total short-term portion of the long-term loan. So in the payment that's going to take place on the 31st of December will be based on the outstanding capital balance of 1,336,456 multiplied by 8% for a 6-month period, which will give you interest of 553,459. I don't use the 53,458 anywhere in my statements at this point of time, but what I need that for is to split out what was the capital portion of the payment of 223,544. So 223,544 less the interest portion included in that amount gives me the capital portion of 170,086. After that payment has taken place, it will be 1,336,456 less 170,086 gives me a remaining capital balance of 1,166,370. We always calculate interest on the capital which is outstanding. So 8% of our outstanding capital balance for the next 6 months or the last 6 months of the next financial year will then be 1,166,370 times 8% once more for 6-month period, which is going to have an interest payment of 46,655 included in the total payment of 223,544. The difference between the two, again, will give us the capital that will be repaid with that installment of 223,544, which is 176,889. At the end of next year, there will be an outstanding capital balance then of 989,481, the 1166370 less the 176,889. So in our statement of financial position, these three payments will then be equal to our short-term portion of our long-term loan. And the long-term portion is going to be equal to 989,481. If I'm going to add the 989,481 with a 510,519, I'm going to be back at the total outstanding balance at the end of this year of 1.5 million rand. So going to my statement of financial position, under non-current liabilities, long-term loan, I'm going to show the 989,481, that amount there. And under current liabilities, short-term portion of the long-term loan, I'm going to show the 510,519, which equals those three capital payments in the next financial year, 510,519. That accrued interest I have to show as part of trade and other payables, not part of the loan, part of trade and other payables. So that 60,000 will be that 60,000 interest payable or accrued interest of 60,000. Good, now payments due. Total credit invoices received and still outstanding on 30 June 2018 amounted to 232,560. This amount is owed only to two creditors, namely Billy Joe Products and Sammy Clean Suppliers, both sole proprietors. The amount owed to Billy Joe amounted to 162,792. It's a bad cut-off here. 162,792. Mpetsi negotiated with Billy Joe Products to receive a settlement discount of 5%. Should Mpetsi settle their accounts within 30 days of the invoice date. On 30 June 2018, Mpetsi still qualified for the said discount. Mpetsi has never missed out on a 5% settlement discount. Billy Joe Products is the only supplier granting such settlement discount. Now, guys, our total outstanding creditors is still going to be 232,560. But this long sing-song and dance is all about what is the allowance for creditors, for settlement discount on creditors was supposed to be. They say it's only applicable on Billy Joe, and Billy Joe has got an outstanding balance of 162,792. What is the 162,792? The invoice value. How do we derive from invoice value to allowance for settlement discount? Number one, determine the invoice. Number two, take out the VAT. Number three, multiply the settlement discount percentage to the VAT exclusive amount. And that then gives you the total amount that they will be able to claim as a settlement discount exclusive of VAT of 7,140. So if we go to trade and other payables, you will see here that we have the balance, the total balance of 232,560, less allowance for settlement discount, which is the 162,792 divided by 1.14 times 5%, which gives us a total of 7,140. Strictly speaking, you should have had here a total of net trade creditors if they did ask you the trade and other payables note. However, here the trade and other payables note is purely for you for calculation purposes, so therefore it does not 100% have to comply to the IAS1 prescriptions for trade and other payables. Good. So that then gives us total trade and other payables of 285,420, and there you will see it, 285,420 trade and other payables. Guys, do you see that the short-term portion of the long-term loan is a separate line item on the statement of financial position, and it is not included in trade and other payables? The last portion of the question says, on 25 June 2018, I, that's not Ismail, have authorized a payment to Yellow Insurers for a payment of the insurance premium amounting to 6840, which will cover the period from 1 July 2018 to 31 December 2018. Now, 1 July 2018 to 31 December, the full period falls within the next financial year. The payment does reflect on the bank statement on 29 June 2018. So the payment has already been made. However, I have not yet recorded the transaction in the accounting records of Mpetsi. So what should he have done? He should have said debit the insurance account with a VAT exclusive amount of 6,000 Rand. You should have said debit the VAT control account with a VAT input of 840 Rand, and he should have said credited bank with a full amount of 6840. So at year end, as part of his year end closure entries, he had to pass this entry in his books, and whenever that will in any case disappear then from his bank reconciliation, but my records is wrong not to include that. This is not debit insurance, this is debit prepaid insurance, because it is all to do with the next financial year. Prepaid insurance for 6,000 Rand. Now, prepaid insurance, you know, is part of trade and other receivables. So if you go back to our trade and other receivables calculation, there's our prepaid insurance of 6,000 Rand. Also, we're going to claim the VAT now, the VAT input on the insurance of 840 Rand. So now it looks like that this computation is now complete. So we can calculate the final balance on the VAT control account. We can transfer that to trade and other receivables, and then we can add all the trade and other receivables together to give us a 516540, which is reflected on the face of a statement of financial position. On 30 June 2018, also end of the year, the bank account, as per the accounting records of the general ledger, showed a favorable balance of 400,000. But remember what we have done now. We have now made an adjustment entry of 6840, and that was a payment. So a payment against that of 6840 gives us then a total of 400,000 less 6840, 393,160. Before we go and put that very over hastily in our statement of financial position as part of cash and cash equivalents, let's just read the investment story. Mpetsi has had surplus cash available on 30 June 2017, the beginning of the financial year, and management decided to invest 200,000 Rand with Standbank at an interest rate of 7.5% per annum. All interest for 2018 in terms of the investment have been received and properly recorded, so we don't have to worry about that. The investment, however, expires on 31 December 2018. What is the definition of cash and cash equivalents? That is all investments that can actually be liquidated or converted into cash within a 3-month period. Now, from 30 June to 31 December is not a 3-month period. It is a 6-month period. So therefore, it's not part of cash and cash equivalents, but if it did fall within the 3-month period, that would have formed part of our total amount of cash and cash equivalents. However, at this point of time, it won't, because it's not within the 3-month period. So if we're going to go to our cash and cash equivalents, that is going to be the amount of 393,160, cash and cash equivalents 393,160, and that 200,000 under current assets, short-term investments, 200,000 Rand. So not part of cash and cash equivalents because it does not actually adhere to the definition of cash and cash equivalents. Then the last one is straightforward on inventory. On 30 June 2018, we had inventory on hand of 45,000 Rand. So we can just insert that under current assets, inventory there, 45,000. We can add our total assets together. That gives us 3546919. Because we didn't do equity, we cannot add everything together here because it doesn't make any sense. And that is the end of this question.